The clerk will now proceed to read the orders of the day.
Bank Resolution Recapitalisation Bill, Lords, as amended in Public Bill Committee, to be considered.
We need a whip. You need a whip.
Now.
We will begin with new clause 3, with which it will be convenient to consider the amendments as listed on the selection paper, and I call Mark Garnier to move new clause 3.
I beg to move that the new clause be read a second time.
Mark Garnier.
Thank you very much, Madam Deputy Speaker. So, Madam Deputy Speaker, before I move on to new clause 3 specifically, let me reiterate that we on this side of the House welcome the Government's decision to carry over the legislation, or this legislation, from the last Parliament, and that the principles underpinning the bill continue to enjoy strong cross-party support. We all want, and we all need, confidence in our banking sector. Yet the failure of Silicon Valley Bank, SVB, exposed a gap in our resolution framework for smaller banks. And unlike larger institutions, they do not hold the bail-in bond mechanism, otherwise known as MREL, reserves in order to facilitate recapitalisation in the event of a crisis. And that, Madam Deputy Speaker, is why this bill, by providing the Bank of England with new tools to manage small bank failures, remains both prudent and necessary to protect financial stability and public funds. So as we move to consider the amendments that we have tabled at report stage, I want to make clear that our approach is constructive and focused on strengthening the bill and not obstructing its progress. As the bill has made progress through both houses, our intention has been to address a series of smaller but nonetheless significant issues that we believe require further attention. And I appreciate that this might be a conversation we can continue in the debate today. And so I would certainly welcome, or beyond the debate today, and so I would certainly welcome conversations with the Minister, and she's always been incredibly open to direct conversations in her usual sort of pragmatic style to further discuss. So if I may start with new clause 3. So we have 3 amendments grouped for discussion today, I believe, Madam Deputy Speaker. And firstly, I'll speak to new clause 3, which addresses a critical gap in this bill's scope, which is the protection of credit unions. These community-focused institutions have seen significant growth in recent years, not least partly driven by the eradication of predatory payday lenders. And they continue to provide a vital role in delivering affordable finance to those undeserved by traditional banks. Membership of credit unions rose from 1.89 million in 2019 to 2.14 million in 2024, an increase of over 260,000 members. Yet while their importance has grown, their inclusion in our resolution framework has not kept pace. The Financial Services Compensation Scheme has paid 10.1 million in compensation to credit union depositors over the past 3 financial years, primarily due to small-scale failures. This underscores their potential vulnerability and the need for a tailored approach to as the sector expands. Their growth is a success story, but it demands proportional safeguards. This bill, however, excludes credit unions from its recapitalisation mechanism. And while their smaller size and unique nature may differentiate them from banks, the question remains, how does the current resolution regime account for credit union failures as the sector scales up? Is there a scope to develop a mechanism that protects members without imposing undue burdens on these community institutions? New clause 3 seeks clarity. It requires the Minister to produce a report outlining how the resolution framework can be adapted to protect credit unions, ensuring their growth does not outstrip their regulatory safeguards. The vast amount of legislation for credit unions was written back in the 1970s. The previous government made significant reforms for credit unions through amendments to the Financial Services and Markets Act, and I welcome the Common Bond Reform consultation that closed last month. So I know the Minister and the government are giving the sector very, very serious consideration. And I'm sure she'll agree with me, this is not about applying bank-style rules to mutuals, but about recognising their unique role and risks. Credit unions are more than financial institutions. They are engines of financial inclusion. They serve often small working-class communities that I know the government wants to support specifically. As the sector evolves, so too must our approach. And we must ensure our regulatory framework grows, and I hope the government supports this amendment. And that does no more than to look more clearly at the available options in terms of when a crisis happens. Madam Deputy Speaker, I now turn to Amendment 2, which seeks to address a concern that has been raised to me by the mutual and building society sector. These institutions are not relics of the past. They are vital components of our financial ecosystem. Although the first named building society was set up in 1775 by ordinary working people, helping themselves to build their financial resilience and get a home of their own, but they are still very current today. Today, building societies hold over £360 billion in assets and provide mortgages for over 3 million people in the UK. They represent a significant proportion of the housing market and are a trusted source of savings for millions more. They provide a clear and important diversification in our financial markets, providing a clear alternative to shareholder banks. And the Labour Party, the party opposite, stood on a clear manifesto commitment to double the size of the cooperative mutual sector, and frankly something that we would agree on this side of the House. Very good policy. There is a good opportunity today for members of the party opposite to demonstrate that commitment to the sector by enshrining in this bill a requirement that the Bank of England considers the risk of demutualisation when using the mechanism enshrined in this bill. There is a genuine fear that, from the building society sector, that without proper safeguards, the recapitalisation mechanism that this bill offers could inadvertently become a backdoor for demutualisation. When a mutual institution faces resolution, the selection of a purchaser from the PLC sector risks permanently dismantling its mutual status, undermining the very ethos that makes these institutions unique. So our amendment provides a proportionate solution. It requires the Bank of England to consider the impact of demutualisation on members and of this sector as a whole, whilst also exploring the feasibility of selecting a mutual sector purchaser if one both exists and meets the resolution objectives. This is not about privileging mutuals at the expense of financial stability, but about ensuring that the bank's resolution tools do not inadvertently homogenise our financial landscape. Silicon Valley Bank demonstrated the need for agile resolution frameworks, but it also highlighted the importance of preserving institutional diversity. Mutuals and building societies often serve communities and demographics that larger banks frequently overlook. Their potential loss would leave gaps in financial inclusion and weaken the resilience of the sector. Importantly, without the millions of mortgages provided by the building society sector, particularly for first-time homeowners, the party opposite's house building plans would be simply impossible. And I hope the Minister appreciates our amendment strikes a careful balance between safeguarding financial stability and honouring our commitment to a pluralistic banking system, one where mutuals continue to thrive as a cornerstone of community-focused finance. And I remind members opposite, it will be much harder to double the size of the mutual sector if, in the event of a failure, recapitalisation is towards is a default mechanism towards the banking sector. So through votes today on New Clause 3 and Amendment 2, I hope the party opposite will demonstrate their manifesto commitment to the mutual and the cooperative sector. Madam Deputy Speaker, if I may now turn to Amendment 1, there remains a genuine concern shared across this House and reflected in the debates in the other place about the risk of the recapitalisation mechanism being applied too broadly, potentially capturing larger banks that already hold substantial loss-absorbing resources such as MREL. We continue to believe that the mechanism should be limited in scope, targeted at smaller banks that do not have the same capacity to manage their own failure. Amendment 1 would limit the use of the mechanism in this bill to what it was always intended to be, and that is a mechanism for smaller banks outside the MREL regime. I appreciate that New Clause 1 and New Clause 2 have already been ruled out of scope, but it may be worth a couple of points on those. So I hope to place on record today that we on this side of the House believe that the time has come for a review of how we set the threshold for MREL, as well as protecting ceilings for depositors under the Financial Services Compensation Scheme. The current statistic nature of MREL thresholds disproportionately affects smaller and mid-sized banks, particularly the challenger banks. By indexing MREL thresholds to inflation, we can ensure that the regulatory framework remains robust over time without stifling competition. These institutions often operate on tighter margins and face significant barriers in meeting rigid capital requirements, hindering their ability to scale and compete effectively with larger incumbents. Whilst we appreciate the Bank of England consultation closed on MREL earlier this year, we hope the government will consider these points. Threshold limits should not stay static with time. Likewise, we welcome the government's recognition of the need to review the Financial Services Compensation Scheme deposits limit. The current announcement of the increase of the deposit protection scheme from 85,000 to 110,000, whilst very welcome, is certainly overdue. But it is worth noting that if the limit had kept pace with inflation, it would be nearly two-thirds higher at around £140,000, according to the Federation of Small Businesses. It's worth noting that only 4.6% of Silicon Valley Bank's UK deposits were insured by the Financial Services Compensation Scheme. And that guarantee...
May I just remind the honourable gentleman that we are discussing what's in scope rather than what's not been selected and not in scope.
Sure. My apologies, Madam Deputy Speaker. It's, there are points which we feel worth noting, but I take her comments. If I may, though, turn to Amendment 3. This is the amendment tabled by the Liberal Democrats. So whilst we share the intent behind this amendment, which mirrors our own amendment regarding MREL limits for banks, there is a critical difference in its approach that gives us reason to pause. Like us, the Liberal Democrats recognise that end-state MREL banks should not be the primary target of this legislation. And however, their amendment introduces a negative statutory instrument requirement that we believe will create more problems than it solves. Our concern lies in the potential impracticality of this approach. Banking crises can unfold rapidly, and as we saw with Silicon Valley Bank UK, where decisions were made in hours, not days. A statutory instrument laid under the negative procedure becomes law the moment the Minister signs it, and that is a good thing. Remaining so, however, unless either House rejects it within 40 sitting days. This creates a window of uncertainty. If members were to pray against the statutory instrument, particularly in times of a hung Parliament, it could trigger market instability, and precisely what this whole bill is seeking to avoid. So whilst we agree with the principle of limiting the bill's scope, we worry that this mechanism could tie the hands of a future Chancellor, hindering their ability to respond swiftly and decisively in a crisis. And for those reasons, we feel we cannot support the Liberal Democrat amendment as it stands. And finally, Mr. Speaker, turning to the Liberal Democrats' growth amendment, Amendment 4, we find ourselves in a familiar and supportive position. This amendment, which seeks to place a further objective on the Bank of England to consider the competitiveness and growth of the market before directing the recapitalisation of failing small banks through a levy on the banking sector, echoes concerns raised in the House of Lords in the other place, where we were happy to support it and during committee stage. The government frequently repeats its focus on economic growth, and a goal I think we all of us in this House share. Therefore, the decision to levy the banking sector to cover the cost of a competitor's failure must be carefully weighed against the broader growth objectives. Given the current economic climate, where taxes and borrowing are up and business confidence, jobs and growth are down, the government has an opportunity to demonstrate its commitment to economic growth through this legislation, and we of course hope they will. In conclusion, Madam Deputy Speaker, we support the overall aim of this bill. It will strengthen our banking system and will strengthen our banking resolution framework. And as I said at the start of this speech, this bill was originally drafted by the previous government and retains cross-party support. Yet we have highlighted several key areas, and there's small details, but that we believe require further consideration, something that I hope the Minister will consider. From ensuring the mechanism is not extended to MREL banks, to protecting mutual societies and credit unions, and safeguarding the financial services compensation scheme against inflation, our amendments aim to improve the bill's effectiveness and fairness. And not only that, but something that is entirely in line with the promises of the party opposite made during the general election. So I very much look forward to the party opposite supporting their own manifesto, Madam Deputy Speaker. Thank you very much.
Credit unions accessing Bank of England liquidity facilities.
The question is that new clause 3 be read a second time. I call David Pinto-Duschinsky.
Thank you so much, Madam Deputy Speaker. And I rise to speak in opposition to Amendments 1, 3 and 4. Madam Deputy Speaker, under the party opposite, the country was subjected to years of economic chaos. This government has made restoring stability a cornerstone of our strategy to boost long-term growth. Ensuring macro-prudential stability, underpinned by an effective recovery and resolution regime, is a key part of that. Changes undertaken in the UK and globally through the Basel III reforms have made our large banks safer and more resilient, and we should welcome that. The reforms have improved solvency and reduced risks for the taxpayer. However, the collapse of Silicon Valley Bank in 2023 has demonstrated the need for new tools to help minimise the risk to consumers, taxpayers and broader financial stability posed by small bank failures. We need an approach that goes beyond the bank insolvency procedure, and that is why the proposals in this bill enjoy so much support across our financial services sector, as I know from my role as chair of the APPG on financial markets and services. But in designing this new approach, we must make sure they reflect the lessons of experience. I have to say in all candour that I am concerned that these amendments do not do so and will impede the functioning of the new regime, rendering it less effective at moments of crisis. Madam Deputy Speaker, I was an advisor in the Treasury to Alistair Darling during the global financial crisis, when we had to resolve and recapitalise a number of major banks. The action the Labour government took then, often in the face of resistance from the benches opposite, helped save our financial sector from catastrophe and stabilise not just the UK, but the global economy. There are many lessons to be learnt from that period, but in relation to this bill, one stands out. What we learnt when we had to act to save our banking sector was that successful resolution relies, among other things, on two key factors: speed and flexibility. It's a combination of these factors that was so important in 2008, and since then, I would argue they have only become more so. In 2008, we watched banks' liquidity and solvency deteriorate by the day. But now, as the example of signature banks' collapse in the US in 2023 shows, the combination of banking apps and social media mean that a full-scale banking run can develop in hours or even minutes. If we are to resolve banks successfully, regulators must be able to move as quickly. Speed has become more important than ever. So too has flexibility. As we see increasing financial innovation and diversification among banks, with new challenges, new forms of institution, and new types of markets and assets emerging, allowing regulators sufficient flexibility has become more essential, not less. The value of flexibility was demonstrated in the case of Silicon Valley Bank's UK subsidiary, where it was the creative use of powers to resolve the bank through a sale rather than putting it into the BIP that protected consumers, minimised market turbulence, and shielded the public purse. Contrast that with the US regulators' approach to the parent company, Silicon Valley Bank, where rigidity and a mechanistic failure to apply major bank rules led to failures of regulatory oversight that contributed, as US regulators have acknowledged, to the bank's failure. Why do I raise this? Because I fear Amendments 1, 3 and 4 will militate against speed and flexibility and will reduce the effectiveness of the bill, especially in acute crisis situations. Let me start with proposed Amendment 4. This would require the Bank of England to consider the competitiveness and growth impact on the market before directing resolution through the FSCS. I'm afraid that however well-intentioned this is, this could have a potentially very damaging effect. At a moment of crisis, when policymakers have sometimes just hours to act, it would place a duty on them to make a market assessment, which, by the way, could presumably be challenged. This is simply impractical and could fatally slow down action to restore financial stability. As someone who has sat in the room during a bailout process, I have to tell the proposer of this amendment that spending time on this kind of exercise during a disorderly bank failure is simply a luxury you do not have. I am also concerned that such a requirement would have a chilling effect, staying regulators' hands when they have to act quickly. This could not only increase the risk of disorderly collapse, but also raise the cost to the FSCS of recapitalisation if it does proceed. Experience tells us that the longer you put off resolution, the more expensive it becomes. This is a recipe for higher risk and higher cost. Moreover, leaving aside the practical difficulties, the underlying logic is flawed. Firstly, in seeking to analyse the market before deciding on whether to resolve an institution or wind it up, you are putting the cart before the horse. Surely a much better course of action is to prevent the potentially disorderly collapse of the institution and then work out its long-term future and the role, if any, it should play in the market. Secondly, the amendment fails to take into account other objectives that the PRA should properly consider in deciding whether to act, including the protection of retail savers, the prevention of contagion, and safeguarding macroprudential stability. As drafted, the amendment, again, however well-intentioned, could distort PRA decision-making. Its intentions may be good, but its impact might not be. The same is unfortunately true of Amendments 1 and 3. Both seek to circumscribe the use of the FSCS via statute to prevent it being used to bail out larger institutions. The amendments would rob regulators of the flexibility to use the instrument in unusual or unforeseen circumstances in the name of solving a problem that does not exist. The powers provided for by the bill are already aimed squarely at smaller banks, and there are various safeguards in place in the bill's text to prevent its use with larger banks in most scenarios. For instance, the bill states that the FSCS-funded resolution may only be used for institutions that are placed in a bridge bank or transferred to a new institution. And this wouldn't be applicable for larger banks in most scenarios, as they are expected to be resolved through an MREL bail-in. The bill also provides for de facto Treasury sign-off, requires the Chancellor to report to Parliament on the use of the powers, and mandates the bank must inform the chairs of the relevant parliamentary committees whenever an FSCS-funded resolution is undertaken. As such, it is already well policed and circumscribed. There is little danger of this approach being regularly or routinely used with large banks. Adding a statutory prohibition on using this approach with firms meeting their minimum MREL thresholds would add little, but it would create risk. My experience in the Treasury during the global financial crisis and in my work across financial services since then, is that we cannot say the highly improbable will never happen, and we cannot always predict what form the next crisis will take or what will trigger it. The members opposite should surely understand this lesson better than most. After all, it was Liz Truss's disastrous mini-budget that sparked market chaos through a product, LDIs, that most people had never heard of and that were thought to be very stable and low risk. Given this, it would be exceptionally unwise to statutorily bar the PRA from being able to use all the tools at its disposal in exceptional circumstances. There are eventualities that, however unlikely, are possible, such as a well-capitalised bank suffering a very rapid deterioration of its position due to a mass redress event. We must allow the bank flexibility to have access to the tools the bill provides in exceptional circumstances to ensure stability and to protect the taxpayer. We must not bind its hands in a crisis. The power of the government's proposals lie in their ability to be deployed rapidly and with flexibility. That is what will give them their traction and help safeguard our financial stability. It's critical we preserve those facets of the bill, and it's for that reason that I urge the House to join me and reject those amendments. Thank you.
I call Clive Jones, Lib Dem, spokesperson.
Thank you very much, Madam Deputy Speaker. The Liberal Democrats are supportive of this bill because the last thing taxpayers need to worry about are the consequences of an under-regulated banking sector. However, I've brought Amendment 3 on from the committee stage because the size of banks eligible for the new mechanism has been a key debate through the bill's passage. The Minister has regularly set out that the bill's stated aim is to enhance the resolution regime to respond to the failure of small banks. However, the actual bill does not restrict the regime to small or medium-sized banks. If applied to large banks, it would create high costs for banks and for customers. These costs would persist for many years, adding a significant long-term burden on the banking sector and consumers. Our amendment would ensure that the bill does not apply to banks that have reached end-state minimum requirement for own funds and eligible liabilities, or more simply, the largest UK banks. This would therefore mean only small and medium-sized banks can be supported by this mechanism and protect consumers and the banking sector from unnecessary financial burden. Moving to Amendment 4, this has been brought back from the committee stage and would place a further objective on the Bank of England to consider the competitiveness and growth of the market before directing their recapitalisation of failing small banks through a levy on the banking sector. We believe further considerations for competitiveness and growth of the market are important to consider before directing the recapitalisation of failing small banks. To conclude, I would be very grateful if the Minister could go into further detail from the remarks that they made in the committee stage as to how precisely the amendment would complicate the process of managing a bank failure. Thank you.
Minister Emma Reynolds.
Madam Deputy Speaker, it's always a pleasure to serve under your chairmanship. I'd like to thank the honourable gentlemen, in this case, honourable members opposite, for their amendments and for their constructive engagement throughout the bill's passage. This bill will ensure that the Bank of England remains equipped with the necessary tools to effectively manage bank failures in a way that minimises risks to the taxpayer, protecting the taxpayer, and to UK financial stability. Whilst there may be some agreements on the finer detail of this bill, I think what we've heard today and also at second reading and in committee demonstrates that there is cross-party support for the principles and overall objectives of this bill. And I thank the honourable member for Wyre Forest and the honourable gentleman for Wokingham, nearly forgot your constituency, for what you've said today about supporting the principles and objectives of the bill. The amendments in this group cover a broad range of issues, so I will therefore explain the government's position on them in turn. But I also wanted to thank my honourable friend for Hendon for setting out his experience of the banking crisis and stressing that the mechanism that we are seeking to provide in this bill must allow the Bank of England, in close consultation obviously with the Treasury but also the other financial services regulators, to act with speed and flexibility at times of crisis. There are hours, not days, in which to make these decisions, and at the forefront of our minds when discussing this bill, we have to remember that often this takes place over the weekend, as it did under the previous government with Silicon Valley Bank. I will turn to that example in a bit more detail later in my speech, but I wanted to thank my honourable friend for Hendon for setting out his concerns for any amendments that would essentially stymie the effectiveness of this bill. I will now turn to new clause 3, Madam Deputy Speaker, which is about the bill's impact on credit unions. And I note the honourable gentleman, the Shadow Minister, raises a number of issues. I think some of them, if he doesn't mind me saying, are strictly speaking not relevant to the content of this bill, but I'll come on to them. The government overall, as he knows and he noted, absolutely supports credit unions. They play a vital role in providing saving products and affordable credit in local communities across the country. However, they are not in scope of the resolution regime, which we are discussing today, and therefore not in scope of the new recapitalisation payment mechanism introduced by this bill. That is a benefit to the credit union sector, and indeed something that they asked the government to do to ensure that they were not included in the payment mechanism. And therefore they will not be liable to pay towards the cost of a failure where the mechanism is used. And I just wanted to set out the detail about the resolution regime and why credit unions aren't involved in this case, and remind the Shadow Minister and others of this. So under the resolution regime, the Bank of England has a set of powers it can use to manage the failure of banking institutions in order to protect financial stability and public funds. In order for the Bank of England to use these powers, certain conditions must be met, including that resolution action is necessary and in the public interest. It is unlikely that these conditions would be met in the case of credit union failures, given their size and the reduced likelihood of contagion if they fail. It is therefore appropriate and proportionate that these firms are out of scope of the resolution regime and placed into insolvency when they fail instead. The government does not therefore believe it's necessary for a report to be produced on the impact of this bill on credit unions. Nevertheless, I appreciate the points he is raising about access to liquidity facilities. Credit unions are not currently eligible to access the Bank of England's liquidity facilities, but the bank does continually assess the types of firms that are eligible. But I would just gently say to him, with eligibility to these liquidity facilities, there comes additional responsibilities on the behalf of the firms that benefit from them. I think that's worth bearing in mind. I would also reiterate the government's clear, strong support of the credit union sector, and that we continue to engage regularly with the sector to understand the barriers they face to being able to grow and to compete. Oh yes, sure, please.
I commend what the Honourable Lady has mentioned about the credit unions, and I support that wholeheartedly, because in Northern Ireland the credit unions have a big role to play, as they probably do in other parts of the United Kingdom. When it comes to the crisis, if I don't mind asking this question, please, if I can, just for the record, my concern when it comes to crisis in banks Credit unions belong to their members. The banks have a different hierarchy. They've got the chief executive, they've got the directors to pay when it comes to the and I believe the issue of the unfairness of bankers retaining the bonus while the pensioner who has saved all his life and all his pennies, that they, no matter what the crisis is, they still get their dividends, they still get their bonus. Can I ask a simple question? Within this legislation and the rules we have here, can we be assured that the bankers, the ones at the top who are maybe responsible or certainly acting responsible for the banks, will find that their bonuses will not be delivered to them?
Minister.
Well, he draws me into discussing something that isn't pertinent to the amendments, but I understand why he's asked that question. When a bank fails, there is a hierarchy of creditors, and that ensures that those who have, and I can write to him with that hierarchy, I don't have it in my pack or in my head at the moment, but it ensures that those who have already invested in the bank are, if, for example, the bank is bailed in, become stakeholders of that bank. But it depends on the resolution scenario and the resolution and where they are in that process. But that is something that we're not. I'm happy to write to him about that. But what I would say to him is that obviously the people who have deposits in the bank or bank accounts, in more simple language, with the bank, are protected up to £85,000, and soon that will be increasing in the way that the Shadow Minister suggested. Madam Deputy Speaker, to come back to the amendments, I'll now turn to Amendments 1 and 3 in the name of the Honourable Member for Wyre Forest and the Honourable Member for Wokingham, respectively, which both relate to the scope of the bill, something we have discussed at length during the bill's passage in this House, but there was obviously discussions in the other place on this issue too. The Government's position remains that the mechanism in this bill is not intended to support the resolution of the largest banks, and the Honourable Gentleman set that out in his speech, Honourable Member for Wokingham. The largest banks will continue to be required to hold MREL to self-insure against their own failure. For banks that are required to hold MREL, the Bank of England should in the first instance use these resources to recapitalise such a firm in resolution rather than resorting to the new mechanism in the bill. It is right that shareholders and investors in the firm should bear losses before anyone else, and that actually comes to the point that was just raised with me by the Honourable Gentleman. However, I come back to the primary purpose of the bill, which is to protect the taxpayer. Bank failures are by their nature highly unpredictable, and my honourable friend for Hendon made that point in his speech. In the unlikely circumstances where a top-up is needed to resolve a bank once all its MREL resources have been used, honourable members must consider whether they want these costs to be borne by the taxpayer. It is the Government's belief that the taxpayer should not be on the hook for these costs. I made this point at the committee stage, and I make it again today, that there are safeguards in place to prevent inappropriate use of the mechanism. The Treasury, for example, is involved in the exercise of any resolution powers through being consulted about whether conditions for resolution have been met. The Treasury would also need to approve any resolution action with implications for public funds. If the Bank of England requested a large sum from the Financial Services Compensation Scheme, which the Financial Services Compensation Scheme could not provide through its own resources, additional amounts would need to be borrowed from the Treasury and would therefore require the Treasury's approval. This means that in practice, Treasury consent would be required if the Bank of England had requested a large sum. Now, the Shadow Minister attempted to draw me into many different subjects related to MREL, which rightly, Madam Deputy Speaker, I think you were slightly reminding him of the scope of the bill and indeed the amendments that we are discussing today. I would, of course, always be happy to have those discussions with him, and it is something that he knows that the Bank of England have consulted on recently, the thresholds. And I note what he said in the debate before he was called to order. He also tried to draw me into questions around the Financial Services Compensation Scheme, which again I think are for a different day, but as he said, that those will be increasing soon. I appreciate that Amendment 3, tabled by the Honourable Member for Wokingham, aims to introduce... yes?
Thank you, Madam Deputy Speaker. Sorry, I'm suffering with my sinuses at the moment. Couldn't really hear. Yes. I appreciate that the scope of the bill is limited, and the Minister is making an excellent case for the government today. I would ask her if she could perhaps write to me to reassure me on a related point, which is the role of bank branches. If there was I realise bank collapses are very unusual, and the government takes a range of steps to try to protect the interests of consumers. Would she be able to write to me about the role of bank branches if a bank was to collapse?
Well, maybe we could have a discussion outside the chamber so I can better understand his question. But the mechanism in this bill is about what happens when the resolution regime is triggered, and there are 4 different conditions that have to be met for that to happen, and also. Obviously, the bill seeks to continuing the work that the opposition started to take forward in government before the election. What we do in the cases like Silicon Valley Bank, how we ensure that if, in this case in Silicon Valley Bank, there wasn't any recourse to public funds, but if there had been, to protect the taxpayer in that scenario. So perhaps we could have a discussion, which I think is a slightly different one, about branch closures, which obviously is something of great concern to members across the House. So, as I was saying, I appreciate the Amendment 3 tabled by the Honourable Member for Wokingham aims to introduce an additional safeguard by only permitting the Bank of England to use its new power on the largest banks if the Treasury permits this through regulations, and he talked about that in his speech. But what I would say to him is that there may be risks associated with this approach, particularly if the Bank of England needed to take a decision at pace in a crisis, and in the way that my honourable friend for Hendon, who was indeed in the Treasury when many situations like this arose. We discussed... We discussed some of these... There were a number of... Anyway, let's not rake over the history. We discussed some of these issues at committee stage, and I think, as the honourable gentleman, the Shadow Minister, has suggested, what we are trying to avoid here would be a window of uncertainty during which an SI would be laid. We need to be the Bank of England working in close partnership and consultation with the Treasury and the other financial services regulators, needs to act swiftly and decisively, often over the weekend. And I would ask members, and the Honourable Gentleman in particular, to cast our minds back to the weekend when Silicon Valley Bank UK was failing. This bill derives from the lessons learnt from that event. What we saw from that incident is just how quickly the authorities, the Bank of England, in consultation with the Treasury, the PRA and the FCA, must move in order to find a solution before markets open and resolve a failing firm in a way that protects financial stability, depositors and the taxpayer. And those protecting the taxpayer, depositors and financial stability have to be at the forefront of our minds when we're thinking about the amendments today. Potentially, the amendment that he puts forward would add a further stage to that process, whereby the Treasury must lay regulations in order to enable the Bank of England to act. This may well, and I would say most likely, hamper those efforts to implement a solution swiftly to achieve those objectives. So had Silicon Valley Bank UK been caught by such requirements, it certainly would have made achieving the solution by Monday morning before markets opened much more challenging. And again, the priority here is to protect the depositors, to protect financial stability. Overall, the government firmly believes that it is better to leave flexibility for the bank, noting the safeguards in place that I've already mentioned. And on the basis of these points, I hope the honourable members will be persuaded to support the government's position on this matter. I know it is an issue of some contention. Now let me turn to Amendment 4, again in the name of the honourable member for Wokingham. And another topic that we've discussed during the bill's passage, on whether the Bank of England should have a growth and competitiveness objective when exercising its new power. Growth and competitiveness are, of course, fundamental priorities for this government. And as I stated in the debate at the committee stage, a disorderly bank failure could pose a serious risk to the growth and competitiveness of the sector and to the UK economy. And this bill seeks to mitigate that risk. Bearing that in mind, the government does not believe that it should impose a requirement of the Bank of England to consider growth and competitiveness when it is taking urgent crisis management action in relation to an individual distressed or failing firm. At such a time, the situation it has to manage is challenging enough without being given an additional broad objective of this kind. The resolution objectives set out in the Banking Act already provide a solid basis upon which it must make its decisions. These include protecting financial stability, protecting covered depositors and protecting the taxpayer. And as my honourable friend for Hendon reminded us, the Bank of England, in close partnership with the Treasury and the other financial services regulators, needs to act with speed and flexibility to maintain financial stability. These considerations are very different to the ones the PRA and the FCA make in their policy-making roles, which the government strongly supports the existence of their secondary objective on facilitating growth and competitiveness. I do note and accept that there is a broader question around how the Bank of England can support growth and competitiveness, but this is a complex matter and one that is well beyond the scope of this bill, and we will be resisting this amendment for those reasons. Finally, Madam Deputy Speaker, I see our debate has attracted quite a lot of discussion around the edges. I will turn briefly, I could hear myself think it would be nice, briefly to Amendment 2, proposed by the Honourable Gentleman, the Shadow Minister. Firstly, I would reiterate that the Government has made clear its strong commitment to support the mutual sector, and I will reassure him that we take our commitment in the manifesto to double the size of the mutual and cooperative sector very, very seriously. And there are many honourable members on this side of the House who serve as Labour and cooperative MPs who have a great interest in this matter, as has been already demonstrated. And I would also point to the package of measures set out by the Chancellor at Mansion House, which include, and he referred to a couple of them, to be fair, the reform, the consultation and the potential to reform common bonds for credit unions in Great Britain. The Chancellor, secondly, asked the Financial Conduct Authority and Prudential Regulation Authority to produce a report on the mutuals landscape by the end of the year. And we also welcome the establishment of an industry-led mutual and cooperative business council, and I attended the first meeting of that council earlier this year. So I will start by saying that I'm grateful to the Honourable Gentleman for raising this issue, and to say also that the Chief Executive of the Building Societies Association has written to me on the issue that he raised, and we are engaging with him and the broader sector on the issues related to this bill, and obviously many other issues that are relevant to financial services and the role that the financial services sector plays in providing vital services to people across the country and as an engine of growth for the wider economy. I understand that the sector's interest in this matter stems from a provision in Clause 7 of the bill, which gives the Bank of England an explicit power to require the issuance of securities by the firm in resolution where the new mechanism in the bill is used. This provides a means for the Bank of England to give effect to a recapitalisation under the new mechanism established by the bill. Its purpose is to provide additional operational certainty that where the Bank of England needs the failing firm to issue shares as part of its resolution, doing so will not be put at risk by the usual administrative process of share issuance. Of course, mutuals have a different ownership model with no shares, and so use of this power with respect to a mutual would require that firm to be demutualised, which brings me to his amendment, which would require further detail to be included in the Code of Practice in relation to demutualisation. Specifically, it would require the Treasury to include guidance in the Code in respect of the Bank of England's exercise of its resolution powers on a building society, in circumstances where the use of the recapitalisation power may result in demutualisation. That guidance would require the Bank of England to give due consideration to the impact of such demutualisation on members of the building society in resolution and on the mutual sector, and in particular where the Bank of England could select a buyer from the mutual sector to avoid demutualisation. The Bank of England is required to have regard to the Code, and so would be required to have regard to this new guidance when exercising its resolution powers. In responding to the concerns raised by this amendment, I would firstly note that the Bank of England already has the power to require demutualisation of a mutual firm when exercising its powers, if that is necessary to execute a resolution effectively in the public interest, and the bill does not change that. There are also circumstances where demutualisation would not be necessary, such as transfer of the assets of a mutual firm to another mutual acquirer, and we saw that back in 2009 when the Dunfermline Building Society, with the Dunfermline Society and the transfer of its assets to Nationwide back then. Indeed, where the Bank of England is seeking to resolve a failing building society, its assets may well prove an attractive acquisition to another mutual. And so a sale within the mutual sector may already be a likely outcome under the existing regime, whether in resolution or in recovery in the period prior to resolution. However, it's worth remembering that the issues we are considering here relate to banks and building societies once they have failed. And in such circumstances, the alternative to demutualisation as part of a resolution may be insolvency, which may have far more adverse consequences for members of the mutual, as well as the wider mutual and banking sector. I'm afraid I'm being urged to wrap up. Can I just remind... Can I just remind honourable members that this bill is fundamentally about protecting the taxpayer. Taking that into account, we haven't come to third reading yet, you can come in on third reading. Taking that into account, while the government appreciates the point raised by the sector and indeed by the Shadow Minister, it doesn't believe it is necessary to hardwire a requirement to update the Code of Practice on this matter in legislation. However, I do understand that this is an issue the mutual sector feels strongly about, and my officials and I will continue to engage with them on it. I commend this bill to the House. I commend our position on the amendments, which is to resist the amendments to the House.
Minister Mark Garnier to wind up.
Thank you very much, Madam Speaker. With the leave of the House, if I can address one or two points that have been raised in this debate. The Honourable Member for Hendon is an incredibly valuable contributor to this debate because of his experience back in the days of the financial crisis in 2008, which was largely, if I remember from the time, as a result of the Financial Services and Markets Act 2000, which almost compounded the problem by having a tripartite regime which was looking after the banking sector at the time. And if I remember rightly, the Honourable Member, the Chancellor of the Exchequer at the time, found it so scary that his eyebrows nearly turned white. But I think one of the surprising things about that crisis was that just 10 years earlier, we'd seen another crisis in the Asian banking crisis, which basically laid the groundwork for what happened subsequently 10 years later in the West. And perhaps we in the West were too arrogant to believe that it could happen to us, and yet it sure did. In my role as a member of the Treasury Select Committee from 2010 to 2016 and the Parliamentary Commission for Banking Standards, I've looked very, very exclusively at all of this, and it's incredibly important that we get to resolve this. And as it's turned out, the Financial Services and Markets Act 2012 and the Banking Reform Act 2014 have worked well in the case of some of this resolution. On the point about LDIs and the financial crisis as a result of a budget, we did deal with this problem pretty swiftly and pretty brutally, Madam Deputy Speaker. When one of our leaders gets it wrong, we do get rid of them fairly quickly. And I would urge the party opposite that if thank you very much. I would urge the party opposite that if members of the front bench do get things wrong, perhaps it should be worth cauterising that problem and moving on. Specifically on the 2 points, credit unions and mutuals, absolutely, we recognise the mutual, the point about the mutual sector. We're not asking for demutualisation to be ruled out. What we are asking is for the prospect of avoiding demutualisation to be part of that very, very swift process. And looking at that, and that's why we will move the relevant amendment. And on credit unions, the credit unions, I met with them yesterday. They're very keen that this point is voted on, and so we will be moving that as well. But thank you very much, Madam Speaker.
The question is that new clause 3 be read a second time. As many as are of that opinion say aye. Aye. Of the contrary, no. No. Division, clear the lobby. The question is, as on the order paper, as many as are of that opinion say aye. Aye. Of the contrary, no. No. Tellers for the ayes, Gregory Stafford, Sir Ashley Fox. Tellers for the noes, Kate Hendon, Gerald Jones.
Order.
The ayes to the right, 88. The noes to the left, 212.
The ayes to the right, 88. The noes to the left, 212. So the noes have it, the noes have it. Unlock. Amendment 2 has been selected for separate decision. I call Mark Garnier to move Amendment 2 formally.
Move.
Is there Amendment 2 be made? As many of that opinion say aye. Aye. Contrary, no. No. Division. Lobby. Colleagues who are standing should be seated. Colleagues who are standing should be... That's lots of seats to be found there. The question is as on the order paper. Have made that opinion say aye? Aye. Of the contrary, no? No. Tell us for the ayes are Sir Ashley Fox and Gregory Stafford. Tell us for the noes are Kate Durden and Gerald Jones. Order, order.
The ayes to the right, 89. The noes to the left, 213.
The ayes to the right, 89. The noes to the left, 213. So the noes have it, unlock. Consideration completed. Third reading. The Minister to move third reading, Minister Reynolds.
Thank you, Madam Deputy Speaker. I beg to move that the bill be now read a third time. I think we can do this in a hopefully more relaxed fashion. Madam Deputy Speaker, as we have discussed through the bill's passage, the Banking Resolution Recapitalisation Bill will strengthen the UK's bank resolution regime by providing the Bank of England with a more flexible toolkit to respond to the failure of banking institutions. As volatility over recent weeks have shown, global uncertainty can have a real impact on financial markets across the world. That's why it's important that the UK remains equipped with an effective financial stability toolkit. The primary objective of the recapitalisation mechanism introduced by this bill is to protect the taxpayer, and as such it will provide more comprehensive protection for public funds when banks fail. As discussed at second reading and in the Bill Committee, I think, and indeed earlier today at report stage, I think all sides of the House can agree that this is of vital importance to ensure our constituents aren't left on the hook when a bank collapses. The bill achieves this without placing new upfront costs on the banking sector, and therefore strikes the right balance between protecting financial stability and supporting the government's #1 priority of driving economic growth. Madam Deputy Speaker, I would like to thank all those in this House and the other place that have contributed to the scrutiny of this bill so far. In particular, I would like to thank the opposition benches for their constructive engagement. There is broad agreement, as I said earlier in my speech, on report stage on the primary objectives and principles of the bill, but I know that there are differing views that have been expressed on the scope of the mechanism and certain other finer details. I would reiterate the government's position that it is important to learn the lessons from the case of Silicon Valley Bank UK, which demonstrates that the implication of a firm's failure cannot always be anticipated prior to the event, and things move very, very quickly indeed. It is important that the legislation therefore avoids being overly restrictive on the Bank of England's ability to use the mechanism in an unpredictable and fast-moving failure scenario, ensuring that the mechanism achieves its primary objective of protecting the taxpayer. I hope that those in the other place will agree that the government's position when the bill returns for their consideration. But at this stage, I would like to thank the Shadow Minister, the Honourable Member for Wyre Forest, the Honourable Members for Dorking and Hawley, Wokingham, and the Honourable Members on both sides, other Honourable Members on both sides of the House that sat on the committee. I would also like to thank the Right Honourable Member for North West Hampshire and the Honourable Members for St Albans and Bridgewater for their contributions at second reading. And I would like to thank my honourable friend, the Minister for Pensions, who assisted in second reading, and indeed who's the Honourable Member for Swansea West, who supported me in second reading, as well as the Honourable Member for Newcastle under Lyme for his input. And I would like to extend my thanks again to my honourable friend for Hendon for his speech earlier today at report stage. I would like to extend my gratitude to my officials in the Treasury for their hard work in developing what is a highly technical bill, one that is not easy to be rushed, and supporting me throughout the bill's passage through the House. I'm also grateful to the House staff, Parliamentary Council and all other officials involved in the passage of the bill. Madam Deputy Speaker, this bill supports the UK's economic resilience to the risks posed by bank failures. We all remember the damage caused by the financial crisis, and this, alongside other measures that allowed failures to be managed in an orderly way, uphold the economic and financial stability that will deliver on the government's growth mission. I'm pleased that this bill has received broad cross-party support, both in this House and the other place, and look forward to its enactment. And I commend this bill to the House.
The
Question is that the bill be now read a third time, and I call the Shadow Minister, Mark Garnier.
Well, thank you very much, Madam Deputy Speaker, and can I first say a hearty congratulations to the Minister for bringing through what I think is our first bill as a Minister in the new government. She was parachuted into the job rather recently, but she has done a magnificent job. And can I also just add, on a more personal, what a pleasure it is to engage with a Minister who is somebody where I think we both share the common interests of the wider economy, and we have worked together on this, and we may differ on a few of the tiny details, but the overall objective of this bill is absolutely one that we agree on. As I think I mentioned a little bit earlier, I spent some time in the Parliamentary Commission for Banking Standards, looking at how we can stop another banking crisis, and also the Treasury Select Committee doing the pre-legislative work on FSMA 2012. All of this stuff is a very iterative and organic process. It is, at the end of the day, we will never, ever, Madam Deputy Speaker, be able to stop and cease financial crises happening. But what we can do is, working together, we can make sure that there are no instances again where we can have contagion flooding through the system. And this bill that we've been debating today is one that actually is extraordinarily good in that iterative process of making the banking system unsinkable, I hope, and I don't use that term lightly, as somebody might have done in the film Titanic, for example, but it really is genuinely very, very important. I would also like to pay credit to the former Chancellor and the former Economic Secretary to the Treasury and their officials who worked tirelessly to ensure Silicon Valley Bank was transferred to HSBC over that weekend. This undoubtedly avoided wider disruption to the financial system. But as I say, we are absolutely delighted that this bill was started in the previous Parliament, and we absolutely reiterate that we welcome the government's decision to carry this bill over into this Parliament. I was about to say our swords are going to cross in the coming months and years, but I don't think they will. I think we will almost certainly agree on things, but we will engage with her and her officials and everybody in order to make sure that we do have a world-class financial system that is the envy of the world. Thank you.
No further contributions. The question is that the bill be now read a third time. As many in that opinion say aye. Aye. Of the contrary, no. The ayes have it. The ayes have it.